Hi, welcome back. In the last session, where we introduced value investing, we talked about the different forms that value investing can take. And one of the forms we talked about was screening for stocks, a passive version of value investing. And this happens to be the most widely practiced version of value investing. What does that mean? You look across companies, and remember there are thousands of publicly traded companies, and you screen for companies that you think are cheap. Those screens can either be qualitative screens. You're looking for companies, companies with good management. Good is a fuzzy word, and if you don't put a number on it, it's a qualitative screen. So are qualitative screens. I'll introduce qualitative screens in this session, talk more about them in the next session. But this session, I'm going to focus primarily on quantitative screens, where you look for stocks that are cheap by looking at the numbers. Let's start with qualitative screens. As I said, just to talk at least in the, put an overlay on them before we turn to the quantitative screens. The essence of a qualitative screen is you can't point to a number. It's not in the financial statements, but you think it matters anyway. It can either be at the company level or at the management level. At the company level, these qualities can include reputation for quality or service, a loyal employee force. After all, they can carry you upwards. A loyal customer base who keep coming back to you to buy your products, or that you care about society and people. In fact, in the last 2 decades, as you've seen the focus on ESG and sustainability, one of the arguments is companies that do more for society, care more for society, should be worth more. At the management level, the qualities could include, as Warren Buffett did, looking at managers who are honest and accountable, being creative, especially in a growth company, being capable. We'll talk more about these qualitative screens later in this class, but I want to focus, as I said, in this session primarily on quantitative screens, and in 3 groups of quantitative screens. The first are book value screens, where you compare what a stock trades at relative to its book value. In the most common version of this, you compare the price per share to the book value per share, either trying to buy stocks that traded below book value or at low multiples of book value. You can have earnings screens, where you look at stocks that trade at low multiples of earnings. Most widely used version of this multiple, of course, is the PE ratio. But you've got enterprise value versions of it, enterprise value to EBIT, operating income, or enterprise value to EBITDA, which is really more of a cash flow than an earnings. And you have cash yield screens, where you look for companies that deliver a cash flow to you in the form usually of dividends, high dividend yields. And in some cases, investors add to these screens to make sure they're not getting stocks that look cheap but deserve to be cheap. So let's start with price to book screens. Price to book value, here's what you're doing. You're comparing the market price per share to the book value of equity, that accounting number for equity on your balance sheet on a per share basis. And here the evidence seems to be pretty straightforward, pretty clear that low price to book stocks have historically done better than high price to book stocks. In fact, if you look at the entire time period, 1927 through 2024, and you break stocks down into 10 classes based on price to book from lowest to highest, the lowest price to book stocks earned 16.32% on average, and the highest price to book stocks earned only 11.9%. The lowest price to book stocks earned a 4.5% higher return than highest price to book stocks. That settles the case, right? But take a closer look at the data, because I've actually broken the data down by time period. And you'll notice as you go through time that the price to book advantage seems to be fading. In fact, between 2011 and 2024, low price to book stocks dramatically underperformed high price to book stocks. File that away, because you're going to notice a pattern as we look at other screens as well. The argument that stocks that have low price to book ratios do better than high price to book ratios is based on the entire time period, but there's a fading towards the end. However, if you look across markets, across pretty much every market, you do see evidence that low price to book stocks outperform high price to book stocks in most markets. So in the US, historically, most markets, low price to book stocks have delivered higher returns. Let's accept that as a premise, notwithstanding the 2011 to 24 evidence. And let's look at why, even though it looks like a surefire way of making money, it might not be. There are 2 things to worry about when you go out and buy low price to book stocks. The first is, from the Farmer French studies, from which this low price to book stock was originally bought. The argument that Farmer and French made was maybe this is a proxy for risk. Maybe low price to book stocks are riskier than they look using traditional risk and return models. And what you're earning as a higher return is compensation for risk. In fact, the Farmer French view of of the factors that they found delivered excess returns was those factors are more likely to be proxies for risk than stand-ins for ways to beat the market. The second thing to worry about is when you buy a low price to book stocks, you might be buying a low quality company. What am I talking about? Companies deliver value by taking the money they raise from equity and putting it into projects on which they deliver a return in equity. If you're a company that consistently delivers a return in equity that is less than your cost of equity, you can expect to earn or trade at a price less than your book value. So when you go out and buy low price to book stocks, you might in effect be getting stocks that actually deserve to be cheap. So something to think about as you embark on that low price to book. There's one other thing that I think we need to factor in when we look at book values is that as we move away from the 20th century America, which was built around manufacturing companies, the 21st century market built around technology companies, is an argument that book value means less and less. There was a time where people argued that book value was a proxy for liquidation value, that if you liquidated a company, you could get the book value back. That's increasingly untrue as you look at service and technology companies. In fact, if you add to it inconsistencies in accounting, especially in the way in which technology companies' capital expenditures, R&D, are being treated in accounting statements, you could argue that the book value of technology companies is massively understated, which can then explain why, even though the price to book ratio today for the S&P 500 is higher than it's ever been, it might not be an indicator that stocks are overvalued. So let's summarize on price to book. You're comparing the price per share to the book value of equity. And historically, low price to book stocks have earned a higher return than high price to book stocks. So that seems to have faded in the last 14. But even that excess return, if you take the entire period, could be a return for taking on more risk or a return that reflects the fact that these companies take bad projects. And increasingly, book value is getting less meaningful. So that's price to book. Let's turn to price earnings ratio. Again, if you look at the overall time period, there is evidence that low price earning stocks earn higher returns than high price earning stocks. But then if you break it down again, and you get to the 2011 to 2024 period, you can see low PE stocks start to underperform high PE stocks. As with the earlier case, you're seeing the fading of the PE ratio effect. But over the entire time period, low PE companies have earned a higher return than high PE companies. Much of value investing's mystique is built around this historical outperformance. But here again, if you're an investor buying low PE stocks, what do you need to worry about? First, you have to worry about the fact that the earnings might be high risk. What does that mean? Well, especially as you've got accounting gaming, you can have high earnings because you're doing really well or high earnings because of accounting manipulation. So that's one factor. The other is a variant of the argument we made with low price to book stocks. Maybe low PE stocks are riskier for whatever reason. The models don't capture that risk. So one is high risk earnings, and with low PE stocks, you might be getting a lot of companies with high risk earnings. The second is a tax issue. When we talked about trading costs and taxes in session 6, we talked about the fact that when you invest in high dividend yield stocks, if you're a high tax rate individual, you might end up with a bigger tax burden than if you buy stocks with low dividend yields. Low PE stocks are more likely to be high dividend paying stocks, and as a consequence, there might be a tax burden you face, which means that after taxes, some of those excess returns might dissipate. And thirdly, you can have a stock that has a low PE ratio, but its earnings growth might be zero, negative, or very low. In other words, you might be just getting a bunch of companies that don't just have low growth, but might be shrinking their earnings. High risk, taxes, and low growth can sometimes get in the way of low PE stocks actually delivering the returns that look like excess returns. In the last 3 or 4 decades, you've seen a shift away from PE ratios, especially among equity research analysts, to a multiple. It's called the EV to EBITDA multiple. What is an EV? EV is enterprise value. Enterprise value is market value of equity plus debt minus cash. In other words, the market value of the operating assets of the company divided by EBITDA, which is earnings before interest, taxes, depreciation, amortization. The people who use this argue that it's a better measure than PE because EBITDA is a cash flow. It's not quite true, but it is a cash flow, but it's a very gross measure of cash flow. The second argument is a purely statistical argument. With PE ratios, when a company has negative earnings, you lose it from your sample. So you could have a sector which has 30 companies and 15 of them might drop out of your sample because they have negative net income. There are companies with negative EBITDA, but there are far fewer negative EBITDA companies than negative net income companies. The pushback, though, is EBITDA is a cash flow, but as I said, it's a very gross cash flow. It's before taxes, before capex. It's not a free cash flow. And as with PE ratios, you have to worry about the quality of growth and the level of growth and checking for risk, because who knows what might be coming through as cheap on an EV to EBITDA basis. Here again, though, a caveat to changing times. As technology companies have become a larger and larger component of the market, the way accountants estimate earnings at technology companies and what they classify or don't classify as capex is having an effect on the earnings that these companies report. So PE and EV to EBITDA are both affected by how accountants treat R&D at technology companies. Again, a note of caution as you go looking for cheap companies based on any kind of earnings multiple. So book value multiples, earnings multiples. Let's complete the story by looking at dividend yields. If you remember the Ben Graham screens, one of the screens, of course, is the dividend yield as high, delivering a cash flow. In fact, I say only half jokingly that Ben Graham's dream of a great company was a bond with price appreciation. In other words, the dividend stood in for the coupon. In this graph and the numbers below, you can see how low dividend yield stocks compare to high dividend yield stocks. And the highest dividend yield stocks historically have earned a higher return than the lowest dividend yield or non-dividend paying companies. Here again, though, the effect has dissipated, decreased, especially in the last 14 years. So as with the PE effect and the price to book effect, the dividend yield effect has also started to lose its oomph in recent years. We'll come back and address that more generally. But across the entire time period, there's the argument that buying high dividend paying stocks would have delivered excess returns. In fact, there are variants of this where people look at what's called the dogs of the Dow, where they look at the company, the largest dividend payers in the Dow 30, and you invest in those dividend players. You have dividend aristocrats. These are companies that not only pay high dividends, but have done it for decades, sometimes a century, and you invest in those companies. The people investing based on dividends argue that dividends are the only tangible return of cash flows, that those free cash flows we compute in valuation are only on paper. So they're the only tangible returns, and that they're more predictable than price appreciation because companies have sticky dividends, pay the same amount year after year. In fact, to back up the notion that dividends are sticky, take a look at this graph. It looks at the percentage of US companies each year that increase dividends, it's a green column, that cut dividends, it's a red column. If I pause right there, you can see about 4 to 5 times more companies increase dividends and cut dividends. And even in really bad years like 2008, far more companies increase dividends and decrease them. But in every single year, if you look at the blue column, that's the companies that don't change dividends, pay exactly what they did the previous year. Most companies pay what they did last year as dividends. That's where the stickiness comes in. That's why investors who are conservative like them, because dividends are predictable. But even as you embark on this path of looking for companies that pay high dividends, especially high dividend yields, here are some things you need to watch out for. One is companies, because they have sticky dividends, might continue to pay dividends even as they get into deeper and deeper trouble. In fact, these dividends might be unsustainable. You're saying, but they're paying them. Eventually, they're going to run into a wall and those dividends are going to disappear. So check to see whether the dividends are sustainable. So how would I do that? The ingredients you need to estimate what a company can pay out are right there in the financial statements. If you go back and review the valuation class, we talked about free cash flow equity, the cash flow left over after you've met every conceivable need. That's potential dividend. If you have a company in negative free cash flow equity that's continuing to pay a dividend, that's potentially unsustainable. It could be that the company has low or negative growth, and that's why it looks cheap and you're earning a high return for the moment. Or it could be a company where the dividends get paid, but you have a high tax rate and you're going to pay higher taxes on the dividend. One final point about any dividend-based strategy that you got to factor in. The world is changing under you. In the US, as you look at how companies return cash, there's been a shift away from dividends. And you can see that in this graph, where I graph out the dividends every year going back to 1988 and the stock buybacks every year. And this is not just a short-term phase, it's a long-term shift away from dividends to buybacks. US companies are increasingly shifting away from dividends to buybacks. What does that mean? If you buy a company just based on dividends, it's entirely possible you might be missing companies that are returning a great amount of cash, but doing it in the form of buybacks. So it is a reality, and it's a reality you got to factor into your investing. One final theme when you screen for cheap stocks, your objective when you're a value investor is to find a cheap stock. But one of your nightmares is you can end up with what's called a value trap. You're saying, what's a value trap? A value trap is a stock that looks cheap, low PE, low price to book, high dividend yield, whatever your metric is, but it stays cheap or becomes even cheaper because the fundamentals in this company have shifted in a negative way. In other words, the market is reflecting the fact that growth has become negative, margins are decreasing, and you keep holding the stock expecting it to revert back to what it used to be. And increasingly in a world where disruption is changing entire sectors, there's a very real chance that what looks cheap to you might in fact be a value trap. So you need to develop your defenses, and here are some of the things that are worth thinking about. First is, if you're a value screener, then you need to run accounting checks. When you do PE ratios, rather than just divide by last year's earnings, you might normalize the earnings. You might adjust the earnings for what you think are accounting shortcomings. Or you can use the Warren Buffett version of owner's earnings. Warren Buffett talks a lot about the moat, and I think there's a good reason for the moat is a measure of a company's competitive advantages. Even though it might just be qualitative, it's better if you can make it quantitative. Even if it's qualitative, you might want to buy cheap stocks that look cheap but have solid moats. We'll talk more about margin of safety, but a margin of safety basically means you could be wrong and you want to give yourself a buffer. So if you have a margin of safety of 20%, in the screening world, you will buy stocks only if the PE ratio is 20% below what it should be, or below the sector PE. You're trying to give yourself a buffer. So do what you can, develop your protecting armor. So if you are developing a screening approach, start with the recognition that the world has become much easier for you to screen in than it was 30 years ago. I have access, luckily, to Capital IQ. Some have access to FactSet. These are huge global databases, and screening can be done in minutes. You can pick the screen you can run the Ben Graham screens in 2 minutes. But if you get carried away, you could be screening for dozens and dozens of things with no common theme attached to them. So if you have a database and you want to screen, here are the things you should be screening for. You want to screen for cheapness, low PE, low price to book. Pick your metric, screen for cheapness. You're going to get a bunch of stocks that trade at low PE or low price to book or low EV to EBITDA. Don't stop. Screen for low risk. Doesn't have to be beta, doesn't have to be standard deviation, it could be variance in earnings. You pick your poison for risk. You want to screen for low risk. You want cheap stocks that are low risk. Then screen for growth. You don't want to end up with companies that are shrinking. Put in a growth rate, be reasonable. If your PE ratio screen is that you want to buy stocks that trade less than 15 times earnings, don't put a growth rate of 50%, but you might put in a growth rate of 10%. So you want cheapness, low risk, high growth, and then look for quality growth. That's a moat component. A return on equity that exceeds the cost of equity. A return on capital higher than the cost of capital. Something that captures. You want cheap companies with low risk and high growth and high quality growth. And doing all of that is much easier than it used to be. And that's a mixed blessing. It's great that it's easier. The fact that everybody can do it might also mean that the days of making excess returns just based on screens are numbered. So, what do you need to succeed at screening if you're a value screener? First is you need a long time horizon. Every single one of those graphs you saw of low PE stocks, low price to book, those returns are not every year, they occur over long periods. You need a long enough time horizon. Second, you need to choose your screens well, which is you can't just screen for PE and stop there. As I said, you got to screen for growth and risk. You are implicitly trusting mean reversion. Things will revert back to the way they used to be, and you have to worry whether that's still the case in a business with disruption. Spread your bets. If you're going to pick stocks with low PE and high growth, don't just pick the one stock with the lowest PE and the highest growth. Do it across 10 or 15 or 20. Law of large numbers work in your favor. And watch out for taxes and transactions costs, because they can eat away what looks like returns on paper can be eaten away by those. I hope you found the session useful, and I thank you very much for listening.